The data tells us what we already know to be true. Stocks that have insider purchases tend to outperform the market, especially over longer periods of time. And if we learn anything from the great Peter Lynch, insiders might sell their shares for any number of reasons, but they buy them for only one: they think the price will rise. So in this video, we're going to be looking at 4 different dividend stocks that just recently had insider purchases. So let's go ahead and jump into it. Now, the very first stock we're going to look at is going to be Texas Pacific Land Corporation. And this is actually a stock that doesn't get a lot of coverage in the media. We can see there has been a massive amount of insider buying over the last few months. Now, what's interesting about this is we can see it looks like in late 2024 and early 2025, there were multiple insiders buying, but over the last few months, all these insider transactions are coming from one single person, and that's going to be one of the directors on the board. Now, the fact he's making purchases every single day does likely mean quite a few of these are planned purchases, but nonetheless, it's a good thing to see. Now, if we look at this stock, it's trading at $1,334.10 per share, and over the past year, it's up by a large amount, over 116%. And if we look at the past decade, the returns are just amazing, up over 2,533%. So what's unique about this business that's made it so successful? Well, we have to understand the difference in TPL, which is Texas Pacific Land Corp, versus other traditional oil stocks. TPL makes money primarily by collecting high margin royalties and land use fees from energy producers on its vast Permian Basin land, unlike traditional oil stocks that also bear the cost of risks and drilling operations. So what does this mean? Well, it means this is actually a very capital-light business model. In fact, if we go ahead and jump over to my profitability sheet, let's come up here and plug in the ticker TPL. Now, what we can see about this business is, yes, revenues have exploded, earnings have exploded, but look at the profitability. The gross profit ratio is above 90%, the 10-year average above 95%. So again, this is a very capital-light business, and this is a huge advantage for the company. So let's take a look at those revenue streams. The largest revenue stream is going to be oil and gas royalties. So basically, they're entitled to a fixed percentage of oil and gas production on their properties. And like I just mentioned, the advantage is these royalties are not burdened by capital expenditures. And this makes up 53% of their revenue. And then we have surface leases, easements, and material, about 10% of their revenue, again, very high margin. We have water sales, and then we have produced water royalties. Now, one of the problems with stocks that have been operating in the oil industry over the last few years is oil stocks have been declining in price pretty dramatically, and typically there's a high correlation with oil prices and oil stocks in general. If oil prices go down, those stocks are going to generally be less profitable. So this is a little bit of an issue for Texas Pacific, but not nearly as much as most businesses. There's a couple of different reasons. One, we've already pointed out, it's a very capital-light business, but number two, if we jump over and look at the balance sheet, come up here and plug in TPL, again, the data will load in, and like always, if you'd like me to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But here's what we want to point out. Not only is it a very capital-light business, their debt to assets ratio is literally 0.00. So the balance sheet is in a phenomenal position, and this is a huge strength for the company during times, for example, when oil prices are going down. Now, let's talk about capital allocation for a moment. To start off, the company currently has a forward-looking dividend yield of about 1.26%, and if we look at that investor's presentation, they highlight something I talk about on this channel all the time. Growing free cash flow per share would further expand TPL's capacity to return more capital to shareholders via buybacks and dividends. They say the key to maximizing shareholder value is to maximize intrinsic value, which can also be expressed by long-term free cash flow per share. So if we look at the capital allocation of their operating cash flow, what we can see is the main priority is paying out dividends. Like you'd expect, capital expenditures is very low and investing activities relatively low as well. So it's clear this company does have some huge advantages, especially when you compare them to more traditional oil stocks. One quick thing I do want to point out is short interest is at about 6%, which is typically higher than I like to see it. But let's talk about the valuation for just a moment. This company trades at quite a premium. If we jump over to Bogle's valuation, come up here and plug in TPL, what we can do is look at the projected earnings growth, the shareholder yield, and multiple expansion to get an expected return over a 10-year time period. Now, we can see the average buyback yield over the past few years is about 0.25%. So we'll plug that in, and what we can see is we now have our shareholder yield of 1.41%. Now, what's difficult is projecting the future earnings growth of this company. And what we can see is the compounded annual EPS growth over the last few years has actually been very high. But the problem is we need to project future earnings. And the thing is, like I said earlier, they don't get a lot of media coverage. So for example, if we look at earnings estimates here on Seeking Alpha, we can see we actually don't have any. Now with ticker data, we actually have found some analyst expectations over the next few years. You can see right here, 2025 EPS is projected to be about $25.58, which is almost 30% higher than the prior year, and in 2026, which is another 18.5% jump up. So earnings are projected to still grow at a high rate, but like always, I prefer to be more conservative with my projections. So let's just say 13.5%. Now with that being said, I think we could definitely see multiple contraction in the case of TPL because the price to earnings ratio is really quite high. So even if we assume the multiple declines by maybe even 30% over the next decade, that'd be 3% a year, you're still looking at an annual expected return of about 11.91%. Now, I will state this is an extremely difficult valuation to perform in the scenario of TPL because there's still so many unknowns, but it's clear the company does warrant trading at a premium. At number 2, we actually have a stock that I own in my personal portfolio and have seen really good gains on, and that is Caterpillar. We've seen a few insider purchases in just the last couple of days, and what we can see is these come from 2 different people, and they're both involved with the company. We can see we have 2 from non-executive directors. Now, Caterpillar in the last year is down about 3.68%, but if we look at them in the last month, they're up 15% as the fear of tariffs have gone away. Now, if we go ahead and look at this company from a dividend perspective, we'll plug in the ticker. What we can see is this is a relatively low yielding stock at about 1.64%, but they don't use most of their capital to pay out dividends, which is obviously a good sign. We can see the free cash flow payout ratio at about 30%, and it's actually decreased quite a bit over the past decade because free cash flow has been growing at a much faster rate than they've been growing the dividend. So obviously, for dividend growth stocks, we'd love to see a low free cash flow payout ratio. Now, if we go ahead and jump over to our stock screener, come up here and plug in CAT, what we can see for the most part, revenue per share over the past decade has been trending upward, and the same is true with earnings and free cash flow per share. But one of the things we'll actually notice if we jump over to the profitability sheet is revenue declined from 2023 to 2024, going from about $67 billion down to about $64.8 billion. But on a per share basis, we can see revenue actually slightly increased. So how did this happen? Well, this is actually a stock that buys back a lot of its outstanding shares. We can see in 2014, it was sitting at about 617 million shares outstanding, and at the end of 2024, all the way down to 486.7K. So buying back shares is a way to artificially boost all of the per share metrics like EPS, revenue per share, and free cash flow per share. And this can potentially be a good way to reward shareholders when it's done correctly, but keep in mind, we want to see organic revenue growth as well, so not a good sign that revenue declined over the past year. But on the bright side, if we take a closer look at what management stated in the recent earnings report, we can see they achieved record organic backlog growth of about $5 billion. So there's still a lot of demand for their products, and obviously the market's excited about the fact that the talk of tariffs are easing quite a bit. So what kind of returns should we expect from this stock? And this is another one where it's a little bit more difficult, but if we jump over to our price to earnings sensitivity model, we can come up here and plug in CAT. Now, first, what we want to do is remove these 2 huge outliers here in 2016 and 2017, but once we've done that, we can see the average PE ratio for this stock over the past decade is about 17.76, and that's with 2020 pushing it up a little bit more. Even if we remove 2020, it jumps down to about 15.58. So here's the thing, the trailing 12 months PE ratio is about 20.55, so it's about 15 to 16% more expensive than it typically trades. So what's the PE ratio going to look like in the future? And obviously this can be affected by many different things, but let's just assume it's sitting at about 18.5, meaning it's going to basically decline closer to that average PE ratio over the last decade. If we look at growth rate projections for earnings over the next few years, it certainly fluctuates quite a bit, but maybe 6% earnings growth for the company could be possible. With that being said, by 2028, it looks like your compounded annual return would be about 10.81% with a total return of 50%. By 2030, the compounded annual return drops down to about 9.18%. At number 3, we have a real estate investment trust that actually pays out dividends on a monthly basis, and that is Apple Hospitality REIT, stock ticker APLE. And they've actually had 4 different insider purchases just in the last week, and that's pretty rare for this company. Typically, there might be some insider selling along with the buying, but there hasn't been any selling as of late. Now, if we look at this stock, we can see in the last year, it's down by about 18%, so a pretty significant sell-off. And if we look at just the last month, they're actually up about 7.39%. Now, the recent news surrounding this company isn't really that great. In the recent earnings report, the company did state that they're going to slightly revise 2025 guidance, which is typically something the market doesn't like to see, and they also have macroeconomic uncertainties that they feel are threatening the business. So that's not great news, and keep in mind, this is a hospitality REIT that owns upscale hotels in the US mainly. So obviously the threat of a recession would be pretty large to this company because their tenant occupancy is already a little bit lower than they typically like to see it. Now, from a dividend perspective, if we come over to the dividend breakdown sheet and plug in the ticker, what we can see is we're talking about a company with a very high starting dividend yield above 8%. But if we look at the dividend payout history for this company, we can see it looks like for quite some time, they paid out stable dividends. Now, typically we want to see dividend hikes that are at least the rate of inflation, so the dividends aren't technically losing their purchasing power over time. But we can also see the company had to drastically reduce their dividend in 2020, just like a lot of REITs did, but still not something that we want to see. Now, since then, the dividend has still not fully recovered to the pre-pandemic levels, but they have been paying out a few special dividends over the past few years. But again, these dividends are paid out on a monthly basis. Now, when it comes to REITs, remember, when it comes to dividend safety, we have to look at things a little bit differently because they're required by law to pay out 90% of their earnings in the form of dividends. So what we can do here on Seeking Alpha is if we scroll down, what we want to look at is the AFFO payout ratio, not the earnings payout ratio, not the cash flow payout ratio, but the AFFO payout ratio. This stands for adjusted funds from operation, and really it's easy to think of this as earnings per share, but basically for a REIT. We can see it's sitting at about 79%, which actually is pretty typical for most REITs, so this is sustainable as long as it doesn't climb any higher over the long term. Now, when it comes to REITs, again, and it comes to valuation, one of the easy ways we can value these companies is by using a dividend discount model. We're valuing the company based on how much they're paying out in dividends and how much that dividend is growing over time. So obviously there's been a lot of fluctuation in the yearly dividends over the last few years because they reduced the dividend pretty drastically in 2020, and then they brought it back up quite a bit, but still not to pre-pandemic levels. Now, with that being said, if we assume just 1% dividend growth from this REIT moving forward, which does appear to be sustainable even with some short-term headwinds, the dividend discount model price per share would be $13.60, which is about 11.6% higher than the current share price for this company. So maybe there is some upside in the long term. And then finally, we have Cracker Barrel Old Country Store Incorporated, stock ticker CBRL. And while some people state that they haven't had many insider purchases lately, it kind of depends on how you define insider purchase, because what's happened in the last couple of months is we've actually seen multiple transactions, but it's from GMT Capital Corporation. And essentially what this is just a shareholder that owns over 10% of the entire company. And again, there's been a lot of transactions in the last few days, in the last few months, and each transaction has been well over $1 million. Now, Cracker Barrel's really struggled in the last year, down about 3.1%, and if we look at the past 5 years, down about 40.8%, and they now have short interest of over 11.32%. If we look at this company from a dividend perspective, I've already plugged in the ticker. We can see the starting yield is about 1.92%, and the dividend history looks pretty shaky for the stock. If we look at the dividend history, we can see they had a dividend reduction. It looks like just in the last year, they reduced it from about $1.30 all the way down to 25 cents. And if you look at these dividend metrics closely, it's pretty easy to see why. Look at that free cash flow payout ratio in 2022, over 100%. In 2023, 92.8%. And in 2024, 285%. Anytime you see consecutive years with free cash flow payout ratios looking like that, you can pretty much expect there to be a dividend reduction in most cases. We jump over to our stock screener, come over here and plug in the ticker CBRL. What we can see is revenue per share has increased a little bit over the last few years, especially post 2020, but that's not what's been happening with the earnings per share and free cash flow per share for the company, which is quite frightening for them. If we jump over to the profitability sheet and plug in the ticker, we can see revenues growing very slowly, revenue CAGR over the past 5 years of just 2.5% and a 10-year at about 2.6%. And obviously the gross profit ratio for the sector they're operating in isn't going to be too high. The average over the past decade is about 33%. So really with Cracker Barrel right now, it's pretty hard to feel good about the company's long-term prospects. But there you go, those are 4 different dividend stocks that recently had insider purchases. Like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.